Alright, this is another video from Running Foresights. My name is James, and today we're going to cover why people look at market data the wrong way, and one of the big mistakes that they're making in the way they interpret the data. Okay, getting into it now. So if you look at a lot of media, one of the things that you'll hear often is you'll see this focus. So you see the short amount of time focused on, and you will see that, okay, here's the peak. This is the highest the price got to. But often, a lot of the time, the focus on the peak is actually not this. This is candlesticks. This will show you that certain prices didn't last very long, depending on the time frame you pick. What they actually will do is they will pick kind of this type of line chart so that you don't see whether or not a price substantially hung out in that area for a long time or if it only spent 20 minutes there. That's one thing to look for immediately when looking at this information. Another thing to look at when you're looking at the information is, okay, so this is what it looks like. It looks pretty bad. Like we came up over here and then we've come down over here, pretty much wiped everything out. And people will look at this percentage here. What you're going to see is that the percentage is quite large. And because the percentage is quite large between here and here, around 50%, then what ends up happening is people are, oh man, something that goes down 50%, that's horrible. So here we get into why the mistakes are made in this market. So when somebody is looking at an asset that is a growth asset, it makes no sense to look at it like it's a stable asset. So a stable asset is something that doesn't go up very much and doesn't go down very much. So you're very concerned about how much it goes down because it never really went up very much. What ends up happening in cryptocurrency, if we zoom out more, is that you get to a point around here. So this is 2017. It looks like nothing compared to where we went, and in a minute I'll show you how even more so this has changed. So people get excited here. They're like, oh, well, we would never pass here, so we passed here. And you get this excitement in the market, and you can see this is not a very long period of time here, between here and here, nor between here and here, and really we're not much lower than we were here. The reason why is numerically people get excited, like from $30,000 to $60,000, that is going to be a 2x. It sounds exciting if you're used to 7% gains. But if you look down here, you're looking at $3,000 prices. This to here is a 10x. This takes us to where the main focus is. High growth markets have exponential growth, meaning that you're not trying to get like 10% or 5%. In an exponential market, people are looking at hundreds of percent, 100%, 200%, 1000%. And in that case, let's say, for example, in this case, someone was buying in here who basically did a 10x on this. When you say they're 50% down, that individual is actually still 500% of their money. So let's say it was $100. This horrific crash happened and now they have $500. Most people wish they could do that, but the problem is the focus here is on this guy gained from here to here, and the focus here is the same thing, here to here, and the focus down here or down here and all in this section was that how much it went down from here. Everyone is focusing on when it goes down, where was the highest place it was before, and when it goes up, where was the lowest place it was before, rather than realizing, how much did we go back to from where we started? That's a different question that you can ask. And then considering that we're looking at these exponential gains, so we're looking at hundreds of percentages, we shouldn't be looking at linear data. So linear data is when you have here, you have like the distance between 4,000 and 8,000 is going to be the same between 8,000 and 12,000. These are $4,000 increments, making this data look like nothing was happening, which becomes a really big problem when you zoom out. It looks like one giant flat line. That's not very useful. So we actually click this down here, log. What log does is it shows us the data on these percentage growths. So if what we were looking to do is get a 2x gain or 100% gain or 10x gain, what we're looking at is here. This is where these gains are in the movement of the charts. Now, if we flip back for a second, there's a flat line. You can't even see it. That's not the right way to look at the data. Look at the data this way. What we see is you got a big crash here. You get a big jump here. Zoom back out. It doesn't look so important. People are still focused on this part. What we see here is that most of the gains are made. You know, this one goes down. Okay, so this was basically this was one rally of the market. This was the 2017 bull rally. This was the pullback. This was the horrible pullback that everyone was super freaked out about. No one wanted to be in the market. And believe me, it was terrible being in the market. Back in 2018, the sentiment was horrible. You needed to have very high conviction. Don't get me wrong, totally understand that. But the way of looking at it, when we look at the data, we realize that, you know, the market participants that really got in at the very end were the only ones who were falling behind. The question here and now for you as an individual to figure out, both in, you know, cryptocurrency as well as other markets where we have these multiple gains, anything that's high growth, is how much does this thing pull back? Nobody knows the answer to that question. It's not a question that somebody knows the secret answer to. And when it pulls back, how much does it go up? But remembering that though this is a huge loss, when we look at it in the perspective of the whole rally, what we see is that it's actually fairly tiny in comparison. And if you're expecting a market, for example, let's say you were expecting this to go to 100K, and you were the buyer at 50K, expecting this to go to 100K, you're only going to get 2x. And knowing that if this market retraced, so, you know, it came back down, that it could come back to these levels. This is kind of the entire rally here. You don't know if it's going to come back here. You didn't know if it was going to come back here. You didn't know exactly where it's going to come back to. You have to factor what is your risk reward. So if you're terrified if it goes down 50% because your upside is only 100%, then that is a one-to-one trade. That's not so great. If you thought it was going to go to 200,000 and you were at 50,000, then 50% down to 25K would have been, you know, reasonable. It would have been a 2x. So you need to figure out the ratio on how much you expect it to go up versus how much you expect it to go down, and what is the trade-off. How much better is your upside than your downside? And then what we'll do here is we'll just quickly switch over to something like S&P 500. And here you can see this is pretty consistent. Like, other than this weird thing that happened shortly in March, for example, this chart's pretty flat. So when we put it on log, it's not really helpful. But when you put it on linear data, you see a different chart. And these are long time frames, so you start to see how much this goes back. And like I said, it's more useful to look at these small percentage gains. For example, you know, since 2009, this is like 5x. So if you're looking at that long, okay. But if you're coming in closer here, you're looking at like a 2x. So you're looking at much lower multiples. So log in this case might not make sense, which might be why you're not used to looking at it that way. All right, that's the end of this video. You have a great day. Please like and subscribe. Leave a comment below if you're interested in me covering more topics.